This house in Snohomish, Washington is listed at $632,000, and we're going to walk through a real mortgage quote to talk about what your monthly payment would be on this house. Now we're going to look at two different scenarios to give you an idea of two different cash scenarios. One where you're bringing more like 5% down to buy the house, and one where you're bringing more like 25% down to buy the house. So we'll walk through a real quote for both scenarios, and in each quote we'll show you what your monthly payment might be. We'll talk about how much cash you would need to bring all into the deal with your closing costs and your down payment, and then we'll also look at how much income it would take to qualify for the loan in each scenario. So as you know, the mortgage process is very complicated and it's full of tons of different concepts that are very important, where one small change in one area can make a massive difference. So obviously coming into the process, you can feel a bit overwhelmed, a bit vulnerable to maybe the lender that you're talking to, the loan officer that you're talking to. So hopefully just coming in and being able to walk through these concepts as we go through this loan, as we go through this quote, I'll walk through some of the most important concepts that you should be aware of. I'll show you what the numbers are on this scenario, but also give you a refresher on some of the most important concepts so that when you come into the process, you don't feel quite so overwhelmed. You at least speak the language a little bit and know what's going on. And then if you're wondering if these are legitimate numbers that you can actually rely on at all, this is a real mortgage quote that I'm pulling. My name is Landon Buto. I work with Cleveland Street Mortgage, a broker based in Bothell, Washington. So this is a real quote that we're pulling on this house. I'm pulling this on April 29th. It doesn't mean these are going to be the exact numbers you'll get when you come in. It's not an advertisement for the exact numbers, for the exact interest rate you might get. But it should be a reliable sense of numbers, and then it'll also give you just a little bit more information behind why the numbers are what they are than you might get on just a mortgage calculator online. All right, so here are the two quotes. There's one on the right, that's the 5% down scenario, and on the left is the 25% down scenario. And then for both of these, I'm using a credit score of 740 to create your quote. I just have to assume, in order to get accurate numbers, I have to assume a specific credit score because obviously your pricing is going to be dependent on your credit score. If you're relatively close to this, if you're in the 700s, it's not going to be drastically different. There is a real improvement typically if you get up. If the way credit score pricing works is typically in 20-point increments. If you get up to 760, for example, your pricing would improve a little bit. If you got up to 780 again, it would improve again, 800, and then the same going down, 720, 700. So if you're in the 700s, it's not going to be drastically different. But if you start to get pretty distant either direction from that 740 number, then you will see a difference for sure. So let's go ahead and look at the numbers. And what I'll do first is I'll walk through this 5% down scenario and show you what the numbers are, and then we'll come back through and talk about the 25% down scenario, how things have changed. In the 5% down scenario, your monthly payment is $4,924, and the payment on that is made up of 4 different components. The first I want to point out here is the homeowner's insurance, which is $150 per month, and that is an estimate. It's just a number I grabbed, but it is a pretty common number for what we see at this price point in this area. So $150 per month is a pretty good idea of what you could expect, but that's going to depend on who your insurance provider is and what coverage you're getting. Just like all insurance, your pricing is going to vary. But we're using $150 per month, and that's a fairly reasonable estimate. Taxes of $479 per month. And on this particular property, when you go to the county website, there are significant exemptions. And so if you look at this property on Zillow or on the county website, the number that they show for taxes is way lower than what you would probably get because there are significant exemptions on taxes for the current owners, for whatever they have some sort of exemption status. So I'm estimating this based on what we typically see as a common tax rate in this county. So $479 per month, and that those two are not technically part of your mortgage, but they do go into your mortgage payment. Sometimes you can get exceptions on that if you really wanted to. Typically it's just easier for everyone, but sometimes you can get exceptions on that. It's pretty rare to be able to get an exception, and Sometimes you have to pay fees in order to do that, and so typically, unless you have a really good reason, it's not worth really bothering about that at all. Mortgage insurance of $145 per month. This is going to be affected by several different factors. So this is an actual number based on this loan program that we're using, based on today's market, but this is going to be impacted by several different things. So mortgage insurance is a cost you have to pay if you put less than 20% down to protect the lender against the possibility of default. It is going to vary depending on what your loan amount is. Right now we have a loan amount of $600,000, so it's a pretty high loan amount. It's going to vary depending on your credit score, because that will show your risk of default. So if you got up to 760 or 780 or 800, then your mortgage insurance might improve significantly. And then it's also going to vary depending on what your down payment percentage is. If you could get it to 10% down, then that would knock your mortgage insurance down. And then 15% down is a pretty important threshold, where if you can make it to that knocks your mortgage insurance down significantly. So this could vary from anything from like $30 per month to $300 per month, or maybe higher depending on your loan amount and all that. But it will also vary depending on your lender, how expensive your lender's mortgage insurance is. Typically, this lender tends to have pretty good pricing on their mortgage insurance. Last component is principal and interest, which is $4,150 per month, and that is a function of your loan amount and your interest rate of 7.375. So again, this interest rate is it is a live number based on the assumptions that I've made to create this quote, but it's not. It requires all those assumptions. It's not the exact rate you're going to get coming in. That's going to depend on several factors. But this is generally where we're at right now, low to mid sevens in the end of April here, almost May. So 7.375 is what we're using for this. And monthly payment, this just means it's just showing your principal, interest, and mortgage insurance components, not including your taxes or your insurance. They're just showing from the lender's perspective what's your monthly payment, even though this is kind of the number that matters up here. Points or credit. Points are a fee you can pay up front in order to get a lower interest rate. Credit is the reverse of that, where you take a higher interest rate in order for the lender to cover some of your closing costs. They give you some cash up front. There are various reasons, various strategies you might do that. You can look into videos that kind of explain that, why you might do that. In this case, we're showing 1,220 in points, and that is the reason that's not zero. So basically, both of these quotes here, we're not really pricing in any points to have a significant impact on the interest rate. The reason that's not zero is because of it's just the way lenders work. They don't really price their interest rate at 0 points ever. They just show certain increments and how much it would cost. So this one's pretty much as close as you could get to zero at the given time that this quote was created. Certain lenders do offer 0 points exact rate pricing, and this lender does, but just as far as generating a quote, this is how they're showing it. So if you didn't have this you're paying points technically of $1,000, then it would be slightly above 7.375. It would be maybe like 7.378 or something like that if you were truly 0 points. But this is just the way lenders show their interest rates generally. The lock period here of 30 days, that just means you have to pay, when you get an interest rate, you have to lock it in. You have to pay a fee of, it's going to vary depending on your loan amount and what your interest rate is. But you have to pay a fee to lock your interest rate. And there are various lock periods. You could go 30 or 45 or 60 or 90. Usually 30 is plenty, and there's no reason to go over that, but occasionally there's a need to go longer. No prepayment penalty. Lender fees of $1,195. Every lender is going to charge you some form of lender fees, that's besides the interest rate, besides the loan. That's just how they cover some of their services and closing the loan for you. So just look at that number, be aware of that when you look at a quote, make sure it's not getting crazy high, but every lender is going to charge some form of that. Other closing costs of $10,673. Now, other closing costs, there's generally two components to that. When you get a loan, you have to pay closing costs beyond your down payment, and generally there's two components. One is just you're paying all the people and the services involved in helping you get the loan, like escrow and title, like the appraisal, the inspection, things like that. So that's one where you have to get the loan, you have to get the house, and people have to help you, and you have to pay for those services involved. And then the other component is what's called prepaids, which is things that are going to be part of your normal monthly payment, but you have to pay some of them ahead of time because it's going to take a while for your monthly payment to get moving, and you're going to be in the house before you start making payments on the house, so you have to pay some of those ahead of time, essentially. And those go into closing costs as well. Typically, this could range from, for this price point, for this loan amount, it will vary depending on several factors, but the most direct impact, the most direct factor that will impact it is your loan amount and your purchase price. And so obviously this is kind of on the higher side, but this could definitely get up in terms of loan amount or purchase price, could obviously get much higher. So if it got higher, it could be closer, if this was in the millions as far as purchase price and loan amount was closer to $700,000 or $800,000, this number could be closer to $12,000 to $15,000. And then if you're factoring in a lot of points, then that's going to go up. But assuming you don't have a lot of points and this purchase price, typically we kind of estimate $10,000 to $12,000. Estimated cash to close. So this is all the cash you're going to have to bring all in. It's your down payment plus your closing costs here. And that is $44,713. So that's your 5% down payment plus almost $11,000 of closing costs. You're going to need $50,000 available to be able to close this deal in this scenario. Now we'll come back and we'll talk about how much income would be required to take on this monthly payment to be qualified for this. But let's walk through the 25% down scenario first and show you how the numbers change. So monthly payment is $1,000 less. $3,906, and that's for several reasons. Right away you can see there's only 3 components here, not 4, and what we're missing is mortgage insurance because we've now hit 20% down, and at 20% down you no longer have to pay mortgage insurance. So that's gone right away. $145 a month, that is no longer on there. Homeowners insurance and taxes will both be the same because those are dependent on the house. Those are not dependent on your down payment, your loan structure, anything like that. So those are the same. And then, which means the rest of the difference comes from principal and interest because we have a much smaller loan amount. We made it to 25% down. So we have a much smaller loan amount, so we're paying interest on a much smaller, and we're paying much less principal, and we're paying interest on a much smaller loan amount. The interest rate is actually the same in this case. Sometimes if you made it from 5% down to 25% down, you'd see a pretty significant difference. One difference you can note here is over here, it took $1,000 in points to get to this interest rate. Over here, since the loan amount is so much smaller, our down payment percentage is much higher. It's only taking $62 in points to get to this interest rate. So technically the interest rate that you're using is the same, but the cost of that interest rate is much lower in the 25% down scenario. 30-day lock period, same thing, no prepayment penalties. Lender fees are the same, and other closing costs are slightly lower, and that's just because we have a lower loan amount here. So none of these much less in points here. So 10,622, and then what that means is estimated cash to close. All the cash you're going to have to bring to close this deal, your down payment of 25% plus your closing cost of $10,600 is going to be $170,000. So if you bring $170,000, you can hit that 25% down price point roughly, based on a few assumptions here, but that's kind of what we're looking at, is $170,000 cash all in. How do you know if the lender will approve you for this loan? Let's say you're comfortable with it, you feel good about it, but how do you know the lender will approve you for the loan in either scenario? here's the calculation that they're going to use to figure out whether you can take it on. It's called your DTI, your debt to income ratio. And your debt to income ratio is your total monthly debts divided by your gross monthly income. In this number, in order for the lender to approve you for this loan, this number needs to be less than 50%. So what is this number? Your total monthly debts. They take this new housing payment you're looking at taking on that would result from your down payment, from your whole scenario. They look at this possible monthly payment, and then they add that to any other monthly debts you have. Student loan debt, car debt, credit card debt, any other monthly debts. They add that all together with your new housing payment that you're looking at taking on. And then they divide it by your gross monthly income, which is your income before taxes. And if that number is less than 50%, then typically under a conventional loan, it's slightly different with FHA, very different with VA, but under a conventional loan, that is how they figure out whether they approve you. If it's less than 50% when they do this number, you're good to go. But the important part here, obviously, if this number checks out, great. You can do the calculations down there. But the tricky part is this number is not always what you think it is, your gross monthly income. At least the number that the lenders are going to use to figure out whether you can qualify is not necessarily going to be the same as what you would have in mind as your gross monthly income. Typically, if you're making entirely salary, then this number is pretty straightforward to figure out. It's going to be very close to what you have in mind. What the lender uses is going to be very close or the same to what you have in mind if you're entirely salary. But if you're making income in other ways, if you have other pay structures such as mostly commission, or you make a lot of bonus, or you work variable hours, if your hours aren't guaranteed, they vary from week to week, or if you're self-employed, any of those, then this number, the way that the lender calculates this number is based on very specific rules that are set just kind of broadly in the market. Typically, sometimes lenders, a lot of times lenders figure out their own, but conventional conforming loans typically, this number has to meet certain standards. Your income has to meet certain standards set by kind of the secondary market, the bigger lenders that buy loans from the lenders that you think of. And so this number there are very specific standards and rules that aren't necessarily super intuitive about how they figure out what this number is. It's a lot more straightforward for salary, but for any of those other pay structures, it's less straightforward. So feel free to ask any questions in the comments on how that works, but best way you are going to figure that out is by just talking to a loan officer, talking to a lender, so whether that's us or someone else. Best way you're going to start to figure out what this number is just go ahead and call your loan officer and give them a little bit of information about your pay structure, your pay setup, and they'll be able to help you figure that out. So if we take that rule, then how do we what is the income that's going to be required to qualify for these 2 monthly payments? Basically, you just double this, assuming you have no other debts. If you have other debts, you take this number, add your other debts to it, $200 of student loan debt every month. You add that to this. But if you have no other debts, you just take this number and you double it, and you need to be making more than that in monthly income. So what is that here? 3,906 is going to be 7,812 per month. And here you'd have to be making 9,848 per month in order to qualify for the loan in each scenario. And so that, again, I say this in every video, I'm not talking about budgeting. That's not an affordability rule. I'm not telling you that as long as you're making $9,800 per month, then you should feel comfortable taking this on. That's not what I'm talking about. I'm talking about whether the lender will approve you for this loan. How much income would it take for the lender to approve you? Now, if you're applying with a spouse, then this number could be household income, assuming it all is usable down here, assuming it all, if one of you just started your own business and you're on track to make $100,000 this year, but you just started it and you don't have a lot of history with it, it might not qualify down here. So that's one example of where that might not fit. But this number could be household income, and as long as your qualifying income, so maybe you make more than this, but you're only going to qualify at around $10,000 per month, because again, maybe one of you makes $10,000 per month, and that's all salary, but the other one recently started your own business, and that's just not going to qualify. Maybe it will, but maybe it won't. Then, in that case, you'd still be safe because your qualifying income is the required amount here to qualify for this loan. So that's roughly how much income you'd have to be making for each of these scenarios. Hopefully that gives you a good idea. If you do want to get a quote on the house that you are looking at, get your own quote with numbers based on your financial situation, we'd be happy to do that. Please do reach out or put any questions in the comments. But if you want to reach out and get a loan, or just get a quote on a house you're looking at, or just ask questions, all of our contact information is in the description below. We are a local mortgage broker based in Bothell, Washington. We work hard to be really price competitive, but also face-to-face service. We're local, small brokerage, and my dad is the owner. He's been doing this for almost 30 years and just has a ton of experience. And you can check out any of his reviews, our reviews, online using the links in the description below and see what it's like to work with us. We'd love to have you. We do loans in Washington and Idaho, so please do reach out.